Hello, friends. Hello, and welcome to Crack CA Exams with us, which is a part of Unacademy. And welcome to Unacademy, India's largest online learning platform. Crack CA Exams with us. The Crack CA Exams is a vertical, a CA vertical started by Unacademy, which caters to the students of CA Foundation, Intermediate, and Final exams and helps them in their preparation for these examinations. And how does it prepare them with their examination preparation? It helps them by providing educators, highly experienced and motivated educators who take on various topics and various subjects and sessions of the subjects that are included in the CA Foundation, Intermediate, and Final course. So let's crack CA exams with us, and I welcome you to the session again. And a little about the educator today. Hello, I'm Prathik Gupta. I am a Bachelor of Commerce from Christ College, Bangalore University. I am an associate member of the Institute of Chartered Accountants of India, an associate member of the Institute of Cost Accountants of India, and also an associate member of the Institute of Company Secretaries of India. I am also a law graduate from Karnataka State Law University and currently a practicing chartered accountant and also a visiting faculty for CA subjects and an educator for CA students both offline and online. Prior to starting my own practice, I worked with SR Bartley Boy and Associates, that is the Indian member firm of Ernst & Young Global in the Audit and Assurance Department, and Ernst & Young India in the Mergers and Acquisitions Department. I also worked with the Manipal Group and was the corporate controller of their German subsidiary and the Indian subsidiary, and the German subsidiary located in Frankfurt, Germany. I wholeheartedly welcome you to the session today. Thank you and welcome to my session. Unacademy has come up with a plus subscription, or Unacademy has a plus subscription, which is a subscription based model for various examinations. And we request you to become a part of the plus program of Unacademy platform. Now, what do you get if you become a member of the plus program of Unacademy? You get daily live classes where you get to chat with your educator, engage in discussions, ask your doubt, and answer polls. Yes, all while the class is going on. You do not need to take a separate appointment or fix a separate time for this, but you can actually clear your doubts and discuss with your educator as and when the class is going on real-time basis. Not only this, the Plus program, Unacademy conducts live tests and quizzes, which help you evaluate your preparation with your other regular mock tests and quizzes, and also detailed analysis of your performance with a feedback to help you identify your weak areas, your strong areas, and the areas you need further improvement and further assistance on. And using this, you can actually chalk out a schedule for yourself to work on your weak areas in order to improve them. The courses offered by the Plus program of Unacademy are structured, or they are structured in line with your exam syllabus to help you best prepare for it. Whatever courses Unacademy Plus program provides to you, those are completely in line with the syllabus of your CA Foundation, Intermediate, or Final examinations. So when you actually undergo a course, you have covered the maximum extent possible as per the syllabus of your respective examination, and maximum efforts are put in to ensure that you do not leave out any important topic or point. And lastly, but most importantly, you get unlimited access. That is, one subscription gets you access to all the live and recorded courses to watch from. And not only this, this is at the comfort of your devices and your homes at any time you want. You can carry the classes, you can carry the sessions in your mobile phone, and view it whenever you find the time, when you're traveling, when you're commuting, when you're in between meetings, and you're pressing for time. In that time, you can refer to all these sessions on your mobile and make use of them. Today, everyone has a mobile phone, and that is why the Unacademy Plus programs are also provided on your mobile phones. So I request you to become a part of the Plus program of the Unacademy platform as soon as possible and take advantage of the opportunities and privileges being offered to you. I look forward to seeing you there very soon. Now, for people who have already downloaded the Unacademy Learning app and are using it already, I thank you very much, and I look forward to your continuous support. And for the ones who have not yet downloaded the Unacademy Learning app, And for the ones who have not yet downloaded the Unacademy Learning app, I request you to go to your Play Store and download the Unacademy Learning app and register on it using a simple procedure, that is, you put your mobile number and from the mobile number you get an OTP. Enter the OTP and your registration on the Unacademy learning app is done. So I repeat, I request all of you to go to your Play Store, download the Unacademy app and register on it using the OTP and make use of this opportunity. Now, what does this help you with? As Unacademy provides the various courses, various resources and contents, it helps you utilize this course and resources on the move. You can do it when you want. You do not need to open your desktop. You do not need to switch on your laptops. You can get on with it directly on the mobile phone as and when you want it, at whatever time of the day you want it, wherever you want it. So it's a very handy tool. I request you to get onto the Unacademy learning app as soon as possible. Now, a little bit more about the Plus program subscription plans. Unacademy has a Plus program for various examinations and courses offered by it. I am part of the CA Foundation and Intermediate, and the CA Foundation and Intermediate subscription plans are as follows. The Unacademy Plus program provides you a subscription plan for 1 month, 3 months, 6 months, 12 months, and 24 months. The 1 month package costs you 3,500. The 3 months package costs you 8,750. The 6 month package costs you 14,000. The 12 months package costs you 17,000 rupees, 17,500 rupees, and the 24 months package costs you 21,000 rupees. Well, these are just the listed price. Please, whenever you decide to make the subscription that you want, do not forget to use the code Prathik, Prathik, to get a discount of 10% on this listed price. So after discount, the costs of those various subscription packages are, for the 1 month package will cost you rupees 3,150. The 3 month package will cost you rupees 7,875. The 6 month package will cost you 12,600. The 12 month package will cost you 15,750, and the 24 months package will cost you rupees 18,900. I repeat again, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on your subscription. Now, out of these 5 subscription packages that Unacademy is offering you, I personally suggest you to go for the 12 months and the 24 months. This is for 2 reasons. Firstly, it is cost effective. If you can see the cost of the various packages, the 12 month and the 24 months packages are very cost effective, and they give you an expiry or a duration for a period of 12 months and 24 months. And secondly, and more importantly, when you prepare for a professional examination or a tough examination, you require normally a preparation time of 12 months to 24 months. And as the this subscription is being provided for the CA Foundation and the intermediate course together, a 12 month or a 24 month package will work out much better for you, both cost effective wise as well as the duration wise, so that you make the most of it. So I request you to make your choice of the subscription. Personal recommendation is 12 months and 24 months, but the end choice is yours. So whatever package you decide to choose, please go ahead with this. And again, don't forget to use Prathik, Prathik, at the time of choosing a subscription to get a discount of 10% on the listed price. Okay. Now let's start off with today's session. Now, if you go to the archives on YouTube, I have taken sessions on incorporation of a company, allotment of securities, and prospectus. So in those sessions, quick recap on those. In the incorporation is what's when you plan to start a company form of organization, that is a private limited company or a public limited company or a OPC or a Section 8 company, which is for non-for-profit organizations. Then you need to adhere to the conditions, rules and regulations given by the Companies Act 2013. So you need to follow all the rules and regulations provided by them. So that session, I've already covered that session in the archives on the incorporation and incidental matters thereon. I request you all to go to the archives on YouTube and go through my session on that. And in case you have any questions or any feedback, please let me know, and I will be happy to address them for you. Okay, and in the next session, I spoke about prospectus and allotment. That was mainly for public limited companies, as to how do public limited companies mainly raise capital. Now, please remember, a company has 2 choices. Either it goes to the bank when it requires more money, or it goes to its existing shareholders who have started the company. But then both these options may not always be feasible, because the banks may not give you a loan because of the businesses, or you have already taken a loan from others and the banks. So then the bank might not give you a loan. And also the existing shareholders who have started the company, please remember, they have their own limitations. They cannot contribute to the capital of the company indefinitely and undeterminedly. So in that case, then a third option comes up, that you raise money through the public or you raise money through others. So in that case, you need to issue a document known as a prospectus, and this is applicable only to a public limited company, because on a private limited company there are restrictions on transfer of shares and prohibition on inviting public to apply for their shares. So only a public limited company can issue a prospectus, that is an advertisement asking people to contribute to the share capital of the company. All right, and then the company issues the prospectus, the money comes in, and then the allotment takes place. Now we will, in this today's session, we will talk about what are the various share capitals in the company and debentures. Okay, now debenture obviously is not share capital, but it is also another source through which a company can raise capital. Quickly, let's start off with, what do you mean by share capital? Now, share capital is the total or the big chunk of the authorized capital of the company that is broken up into smaller parts called shares, which are issued to people in order for them to take it up and pay to the company. So for example, if the authorized capital of the company is 20 lakhs rupees, that will be divided into 2 lakh equity shares of rupees 10 each, and each of those 2 lakh shares are then offered to the public or offered to people to take it up and pay rupees 10 for each share, and then the company collects rupees 20 lakhs. So share capital simply means the entire chunk of the capital of the company broken up into smaller shares. The kinds of share capital can be equity share capital or preference share capital. Now what they are, we will see in the coming up slides very soon. And then there is also a debenture. Now debenture is not a share. Debenture is called a stock, or it is called a security. So whenever we talk about companies, we talk about shares and securities. So shares include equity shares and preference shares, whereas securities include debentures, bonds, and other instruments through which a company raises capital. Okay, so today's session is going to talk about what are the different types of share capital and debentures, and what are its features, what are the options you have, how do you alter the share capital, how do you issue debentures, how do you issue share capital. We're going to talk about all that in today's session. So I request you all to stay tuned, and in case you have any questions at any point of time, please ask me. Okay, let's have a brief introduction. The share capital is the lifeblood of running affairs of the company. Sometimes after the issue of capital of a company may either alter or reduce the share capital depending upon the exigencies of the situation. For desired share capital, a company may also raise a debenture, which has to be registered as a charge. Shares and debentures are financial instruments for raising funds of the company. Under the Companies Act 2013, they are jointly known as securities. Now, as we all know that whenever you start any business, whenever a new business or a new company or a new proprietorship firm or a partnership firm is started off, what do you require the most in the beginning? In the beginning, you require capital. You require money, right? So money is like the lifeblood of the business, and in case initially itself you do not have the money, then the whole business plan and all the company's ideas falls. So money becomes very important to be raised. Now initially, who will give you the money? Initially, the people who are starting the company, the promoters or the proprietor or the partners of the firms and concerns respectively, will put in the money into the company. Later on, as the business grows, where do you get the money from? You get the money from banks, or if it's a public limited company, finally you go on and you raise capital to the public. You offer the securities to the public and you raise capital, or you raise it from the existing shareholders. That's your choice. Okay, now the company has raised the capital. Further, as the time goes on, it wants to start a new business, or it wants to expand its business to a new geography or a new service line or a new product line. In that case, then again they require capital. So again, then comes the need for share capital or money. That again depends on whether you want to issue share capital or banks or debentures. So please remember, a share capital, that is preference share capital and equity share capital, is referred to as share capital of the company, whereas debentures, they are a stock. They are termed as a kind of a loan. When a company issues debentures, it is termed as a loan and you need to register it as a charge. Now what is a charge? In my previous session also I have mentioned, a charge is whenever a company takes a loan and it pledges some of its assets to the person who provides that loan, then a charge is said to be created. That charge, let's say a company takes a loan of rupees 10 lakhs from the bank, and the bank says you need to hypothecate or pledge your machineries or your furniture or your stock. So that action of pledging or hypothecation or mortgaging is called creation of charge, and that particulars of creation of a charge has to be registered with the registrar of companies. You need to give the registrar of companies timely information of whenever a charge is created or whenever a charge is extinguished. Extinguished means when you repay the loan and the loan provider frees the pledge or the charge on your assets. He releases the pledge or charge on your assets. That is called extinguishes the charge. So both the situations, whether you create a charge or whether you extinguish a charge, both of these have to be intimated to the registrar of companies as and when it occurs. The time limit given, I think, is within 60 or 90 days of the creation of charge or extinguishment of charge. It has to be filed with the registrar of companies along with the payment of fee and the necessary documents. The shares and debentures are financial instruments for raising funds of the company. Under the Companies Act 2013, they are jointly referred to as securities. Like I said, shares are equity shares and preference shares, whereas debentures are not shares. Debentures are stocks. So in that case, collectively, they are called securities. The equity shares, preference shares, and debentures collectively are called securities. All right, just take about 30 seconds, go through the slide, we will proceed. Now, let's talk about the types of share capital. Broadly, there are two kinds of share capital limited by shares. That is the equity share capital and the preference share capital. The Act defines preference share capital as instruments which have preferential right to dividend, absolute, fixed or ad valorem, and the preferential repayment during winding up of the company. These shareholders could also participate in the equity pool post the preferential entitlements. Shares which are not preference shares are termed as equity shares. Equity shares are further classified as plain vanilla, same voting rights, or differential voting rights with differences, dividend or voting rights or otherwise. Okay, now let's explain or let's talk about the slide. Now the slide says that there are two types of share capital of a company limited by shares, that is equity shares and preference shares. So there are just these two types of share capital. There is no third type of share capital. Okay, so what do you mean by preference share capital? Now, as the name says, preference share capital is the share that has a preferential right in two matters. Preferential right over whom? Preferential right over equity shareholders in two matters. One is the payment to dividend, and next is the preferential repayment during winding up of the company. So only in these two matters, a preferential shareholder has a preferential right over equity shareholders. Now let's discuss that again. Now we all know that equity shareholders give money to the company. Now what do they get in return? In return, they may get a dividend at the end of the year, or they may not get a dividend at the end of the year. There is no compulsion that a dividend needs to be paid to them. If the company has good profits and if the company decides that okay, let me pay a dividend to these shareholders, then it can pay the dividend. Otherwise, it will not pay a dividend. That money can be pooled in or reinvested in the company for some other purposes. So there is no hard and fast rule. So what do equity shareholders get? Equity shareholders are owners of the company. They get voting rights, and on almost all matters important to them, they get a voting right and they can decide, as well as they get a capital appreciation if the value of the company increases. So as the company does better and better, the value of a 10 rupee nominal value of an equity share increases. It increases to whatever, 50, 100, 200, 500, whatever. So that is the advantage they get. Now let's come to preference shares. Now as I said, they get a preference on two matters, right? One is a preference dividend payment and one is repayment during winding up. Now what is the preference dividend? The preference dividend on preference shareholders could be absolute, fixed or ad valorem. Ad valorem means ad hoc, okay, and fixed or absolute means that the preferential dividend can be already fixed on them at the time of issue. So let's say a preference dividend is fixed on them. So what does the preferential treatment mean? That whether a company makes profits or loss or whatever, they have to pay the preferential dividend to the company at the end of the year. Okay, so they can allow not to be paid for 1 year, but if continuously for 2 years preference shares are not paid the preference dividend, then they get equity rights, or then they get not equity rights, they get voting rights on matters related to them. That is your preferential dividend and other matters. And then when a company is wound up, when a private limited or a public limited company goes into liquidation. In this case, please remember, first what is paid is the government dues, then the salaries and other things, then the creditors, then secured loans, then unsecured loans, then debentures, and then if you have any money left, it will first go to the preference shareholders, and then after paying the preference shareholders, if further there is any money left, then that goes to the equity shareholders. So they get preference on two matters. One is preference dividend and one is repayment at the time of winding up of the company, and that is why they are called preference shareholders. They generally cannot they are not owners of the company and they do not have voting rights, but if you default in payment of the preference dividend to them, they get the corresponding voting rights relating to such default. Okay, then shares which are not preference shares are termed as equity shares. So simply, if the share is issued not as a preference share, then it is an equity share. And equity shares also can be issued in two ways. One can be plain vanilla, that means the same voting rights for all the equity shares, or you can also issue equity shares with differential voting rights. Differential voting rights means you can issue share capital, equity share capital A with all voting rights same to them. Then you can issue an equity share capital B with a little differential equity shares with a variation in the rights in terms of dividend or voting and otherwise. That is also permitted by the Companies Act 2013. Please take about 30 seconds, go through the slide, and then we proceed. I'll get some water. Okay, now let's come to equity share capital. The equity share capital with voting rights or with differential voting rights as to dividend, voting or otherwise in accordance with such rules as may be prescribed. Okay, and preference share capital provided that nothing in this act shall affect the rights of preference shareholders who are entitled to participate in the proceeds of winding up before the commencement of this act. So it simply means there were Companies Act 1956 before the Companies Act 2013 came into existence. There was also a Companies Act in existence before that. So whatever equity shares preferences have been issued in the earlier Companies Act also will have equity share capital with reference to any company limited by shares means all share capital which is not a preference share capital. Preference share capital with reference to any company limited by shares means that part of the issued share capital of the company which carries or would carry a preferential right with respect to a preference dividend and repayment at the time of liquidation. So the act is very simple. The share capital of the company can either be equity shares or preference shares. So an equity share is a share that is not a preference share, and a preference share is a share which carries a preferential right for repayment of capital at the time of winding up and preference dividend year on year. So if a share does not have this preferential right, it is known as an equity share capital. If it has a preferential right, it is known as a preference share capital. Equity shareholders are owners of the company, whereas preference shareholders are not owners of the company. That's the difference between equity shares and preference shares. Please take about 30 seconds, go through the slide, and then we proceed. Okay, now what are your basic requirements for share capital? First requirement, a certificate issued under the common seal of the company or signed by two directors or by a director of the company secretary wherever this company has appointed a company secretary, specifying the shares held by any person shall be prima facie evidence of the title of person to the shares. Now, the whole process of issuing shares is first the company needs to issue the shares, then the subscribers need to apply for the shares. Do you need to pay the application and allotment money? Then the company needs to hold a board meeting and allot those shares or securities to those applicants. And then after the allotment is made, you need to acknowledge the allotment on a document known as a share certificate, which contains details of the number of shares held, the company name, and the applicant's name, and the ledger folio number of the applicant, and details of the shares held by him. All this is, once that is done, once a share certificate is issued by the company, either under a common seal of the company or signed by the company, any two directors of the company, or if the company has a company secretary full time, then for company secretary and a director of the company, then that shall be prima facie evidence that the person is the holder of the shares and no one can dispute that. So once a share certificate with all complete details and inputs is issued, then there is no other dispute or can be raised that about the title of the person to such shares. A duplicate share certificate may be issued if such certificate is proven to be have lost or destroyed, has been defaced, mutilated, or torn and is surrendered by the company. Please remember, share certificates are physical documents, so if it's very old or if it's not stored properly, it will tend to get spoiled, it tends to get torn or wear off, or sometimes it may be lost or destroyed as well. In such cases, the person who was the holder of the share certificates has to prove to the company that he has lost it or it's destroyed, or he needs to show them that it is defaced, mutilated, or torn, and surrender it to the company. And in that case, following the procedure laid down in the Articles of Association of the company or the Companies Act 2013, the company can issue new share certificates to the shareholders. They can follow the procedure and issue the new share certificates to the shareholders. Notwithstanding anything contained in the articles of the company, the manner of issue of the certificate of shares or the duplicate thereof, the form of such certificate, the particulars to be entered in the register of members, and other matters shall be as may be prescribed. Okay, so if the articles of association contains any important provisions for this, for issue of duplicate share certificate, then you need to follow that procedure. If the articles is silent about it, then you need to follow the matters as may be prescribed under the Companies Act 2013. Now, what is an Articles of Association? If you go back to my sessions on YouTube, which I have taken on incorporation of a company, then the two important documents for a company are Memorandum of Association and Articles of Association. The Memorandum of Association is important because it contains about 6 clauses. That is about the name of the company, the registered address of the company, the objects of the company, that is the main objects of the company, why it is formed, and if the company carries on any activities beyond those main objects of the company, those activities are called ultra wires. Ultra wires, the memorandum, and are void. Then the Memorandum of Association also contains the details of the share capital, the authorized share capital of the company, that is what is the authorized share capital of the company and what is it broken into. It has a liability clause that what is the liability of the members. Is it a liability limited by shares, is it a liability limited by guarantee, or is it an unlimited company? And then there is a subscription clause which simply says that all the subscribers to the memorandum give their undertaking that they comply with all the requirements of the act and they agree to take up the shares as mentioned in the Memorandum of Association against their name. So basic thing is the memorandum deals with the external world or the external relationship of a company. Then we have the other document known as an Articles of Association. The Articles of Association gives the internal rules, procedures and policies of the company as to what it is required to follow. So a memorandum is the external document, external relation of the company, and the Articles of Association is the internal relation of a company. It contains details like procedure to hold the board meeting, procedure for transfer of shares between shareholders, transmission of shares of the shareholder, then removal of a director, appointment of a director, appointment of auditors. So all these internal things are mentioned in the Articles of Association. There are various models of articles and memorandums contained in the Companies Act 2013. If a company can decide to either follow those model articles association and memorandum of association or create their own one right from beginning. So the choice is theirs. All right. So let's take about 30 seconds, go through the slide, and then we proceed. Okay, now rights and variation of rights. Now, what are the three topics we're going to talk about this? The voting rights of members holding equity share capital, the voting rights of members holding preference share capital, and proportion of voting rights. Now, like I told you, the voting rights, the first point is voting rights of members holding equity share capital. All the equity shareholders have equal voting rights according to the proportion of equity shares held by them. For example, if the total share capital of the company is 10,000 and you hold 1,000 equity shares of the company, in that case, the said person or you are said to have 10% voting right. Similarly, if a person holds 5,000 equity shares of the company, he is said to have 50% voting rights. And similarly 20%, 5%, 1%, 2%, etc. Voting rights of member holding preference shares. Like I said, a preference shareholder normally does not have a voting right, but if the company defaults in payment of preference dividend for 2 consecutive years, he tends to get a voting right. So the voting right was reserved only for equity share capital holders. And the proportion of voting rights, like I said, for equity shareholders is in proportion to the equity shares held by them. Now, what happens? Now, this is your vanilla equity shares that you have, and everyone has the similar rights. But there might be certain cases in which the company decides to vary or change the shareholders' rights. So let's discuss that. Where the share capital of a company is divided into different classes of shares, it may sometimes be necessary for it to amend the rights attached to one or more classes of shares. The Companies Act states the following laws on the variations of shareholders' right. Variation in rights of shareholders with consent. Here, the share capital of the company is divided into different classes of shares. The rights attached to the shares of any class may be varied with the consent in writing of the holders of not less than 3/4 of the issued shares of that class, or by means of a special resolution passed at a separate meeting of the holders of the issued share of that class. Now, let's say the company has issued equity shares. Equity share capital A series, equity share capital B series. Right now, all of them have the same voting rights and there is no variation. But if the company suddenly finds the need that it needs to vary the rights of those shareholders, the company may change the rights of the shareholders by their consent in writing of not less than 3/4 of the issued shares. Let's say equity share capital A has 10,000 equity shares holding 1 equity share each, and equity share capital B has 20,000 equity shares holders of rupees 1 each. So in that case, if 15,000 shareholders of equity share capital B decide in writing to vary their rights, in that case, at least 15,000, that is 3/4, decide to give their consent for variation in their rights. In that case, the company can go ahead and vary their rights in respect of dividend or voting rights. Or the company may call for a equity share capital B shareholders meeting, and a special resolution has to be passed at that meeting consenting the variation of those rights. Okay, this is a requirement again as per the Companies Act. Now you please take about 30 seconds, go through the slide, and then we proceed. No consent for variation. Now, where the holders of not less than 10% of the issued shares of a class did not consent to such variation or vote in favor of the special resolution, they may apply to the tribunal to have the variation cancelled, and where any such application is made, the variation shall not have effect unless and until it is confirmed by the tribunal. Now what happened? You called for a equity share capital B special resolution, and 15% or 75%, 3/4 of them agreed in writing or passed a special resolution that okay, we are okay with variation in our rights. But what about the remaining 25% of the shareholders? There might be a case where they are not happy with such variation. So the Companies Act gives them an option that if not less than 10% of the shareholders are not in favor of such variation in rights in writing or the special resolution, then they can apply to the tribunal, the company law tribunal, and have the variation cancelled and safeguard their interest. All right. So if it's not necessary that if 75% have agreed, the remaining 25% also have to agree, but it should be more than 10% of the share capital to who dissent to such variation in the rights. Okay, binding decision of tribunal. So now those people have gone. The remaining 25% of the share capital have gone to the tribunal and applied to that. The decision of the tribunal or any other application under subsection shall be binding on the shareholders. So whatever decision the tribunal takes will be binding on all the shareholders of that particular class. Filing copy of order with the registrar. The company will, within 30 days of the date of the order of the tribunal, file a copy with that of the registrar. So whether the company law tribunal agrees to those 25% or rejects their claim, whatever is the order passed by the tribunal, the company shall within 30 days of the date of the order file a copy thereof with the registrar of companies. Default in complying with the provision. Where any default is made in complying with the provisions of this section, the company shall be punishable with fine which shall not be less than 25,000 rupees, but which may extend to 5 lakh rupees, and every officer of the company who is in default shall be punishable with imprisonment for a term which may extend to 5 to 6 months, or with fine which may not be less than 25,000 rupees but may extend to 5 lakh rupees, or with both. So the last point talks about if the company contravenes, that if the company goes on to vary the rights of the shareholders, even though without taking even though 25% have applied to the tribunal, or they do not agree to the tribunal, or they do not file a copy of the order of the tribunal with the ROC within 30 days, in all this it will be considered a default, and every officer of the company, that is the person responsible for running the company, will be liable for 6 month imprisonment or 25,000, which may extend to 5 lakhs, or with both. Okay, so please take about 30 seconds, go through the slide, and then we proceed. Okay, now let's come to calls and incidental matters. Now, what do you mean by calls? Now, let's say the nominal value or the face value of a particular share is rupees 10. Okay, so there might be cases where the entire 10 rupees, and let's say that share is being offered to you for subscription. So it might not, sometimes it may not be necessary that you need to pay the entire 10 rupees right at the time of applying for the share. The company may give you an option that you pay 2 rupees at the time of application, then within 1 week you pay another 3 rupees, and then the 5 rupees whenever we call for that amount. So initially when you make the application for the share, you pay 2 rupees, within a week you pay 3 rupees, and you get the share allotted to you. So what is the amount that you have paid to them? You have paid to them an amount of rupees 5, but whereas the nominal value of the share was rupees 10. So how much is the call unpaid? The call unpaid is rupees 5. So the call may or may not have been made by the company. So whenever the company makes that respective call, you need to pay the remaining rupees 5 also to the company. So let's talk about certain matters which are incidental to calls. Calls are made by the companies on security holders. When I say security holders, it could also include debentures, equity shares, and preference shares, to pay the amount called up in respect of partly paid up securities. Partly paid up, why? Like I told you, a 10 rupee share, only 5 rupees is paid. So it is called a partly paid up share. For the purpose of this section, shares of the same nominal value on which different amounts have been paid up shall not be deemed to fall under the same class. That is, the provision is not applicable where different amounts are paid for the same class of security. Now, okay, now what does this line mean? It means, let's say you have issued a particular, you've issued share capital, equity share capital to the public, and the public have taken up the matter. So in that case, if you issued 10,000 shares to the public and you said, okay, you pay 3 rupees, 7 rupees, you pay it later. So the paid up capital for that share capital, equity share capital, is rupees 3, unpaid is 7. Now you might have also made another share, equity share capital B offer to the public. And for that, the people could have paid 6 rupees instead of 10 rupees. So there the paid up capital is 6 and the unpaid share capital is rupees 4. So what this means, that both the shareholders do not fall under the same category. They should be treated as different categories because they have a different paid up amounts. So the first one has 3 rupees paid up, the second one has 6 rupees paid up. So they are different classes of accounts or security. Okay. Calls in advance. As per section 50, a company may, if so authorized by its articles, accept from any member the whole or part of the amount remaining unpaid on any shares held by him, even if no part of that amount has been called up. That is, if authorized by the articles, the company can keep advance subscription or call money received in advance. Now what happened? Let's take the example that 3 rupees is paid on a particular share and 7 rupees is paid on a particular share capital class. So what the Companies Act allows you to do, the Companies Act allows you to do that even though a call for the remaining 7 rupees and 4 rupees has not been made by the company, but the company can call for that advance, for that remaining unpaid amount as advance and keep that money with him as and keep advance subscription or call money received in advance. For example, the company may not have called up, but then the member has paid it. He has paid the remaining 7 rupees or 4 rupees. In that case, the company can accept that amount and keep it as call money received in advance if they are so authorized by its articles of association. Please take about 30 seconds to read the slide. Okay, now let's talk about another important concept of issue of shares at premium or discount. Before we get into this, let's talk about what do you mean by premium or discount. Now, premium means more than the value and discount means less than the actual value. So let's say nominal value or the face value of the shares is rupees 10. So in this case, the company can issue the share to someone either at more than rupees 10, which will be called as a premium, or less than rupees 10, which will be called a discount. So if the share is issued at rupees 15, if a 10 rupees face value share is issued at rupees 15, then that will be called as a premium of rupees 5. If the same share nominal value of rupees 10 is issued for rupees 7, then it will be said that the the share is issued at a discount of rupees 3. Are you clear with what is the pre-issues of share at a premium or discount? With this, let's move on with the slide. Under the concepts of financial management, fair value of a share may be equal to, less than, or more than the face value of the shares. That means the actual value of the shares might be more than the face value of the shares, less than the face value of the shares, or equal to the face value of the shares. If a security is issued to new investors at a price lower than the fair value, then existing shareholders can make an objection. Okay. Also, issuing the share at value more than or less than the fair value may have adverse consequences under Income Tax Act or under FEMA. So now, let's say if you issued a particular equity share capital to a person for rupees 10, and immediately after 3 months, if you're issuing the same equity share capital to a person for rupees 7, obviously the person who paid 10 rupees for the share will have a problem, right? He'll say, if you charged me rupees 10 and you're charging him rupees 7, you're being unfair, you're charging him 3 rupees less. So a company needs to be very careful whenever they're determining the price, whether it is at premium, whether it is at discount, or it is at the face value. Also, you cannot just issue any shares at discount or at premium, because that will also have implications under the Income Tax Act and will come under the capital gains under Income Tax Act. Okay, so we will talk about that in the chapter on income tax, not in this. So let's look at the points. When a security of a given face value is issued at a price higher than its face value, the issue is called issue at premium, and the differential amount as premium. Like I told you, a 10 rupees face value share, when it is issued at rupees 15, rupees 5 is said to be the premium, and the price of the share is rupees 15. When the issue price is lower to the face value, the issue is regarded at discount, and the difference is known as discount. 10 rupees face value share is issued at rupees 6, then the discount is said to be rupees 4, and the price of the share is said to be 6. There are precautionary provisions contained in section 52 and 53 for both these scenarios, premium and discount respectively, to safeguard the issuer company and its stakeholders. Okay, so while the company is free to issue a share on premium or on discount, there are certain regulations contained in the Companies Act for both that the company needs to follow, and the company has to adhere to all of them regulations when they're issuing shares at a premium or discount. I request you to take 30 seconds, go through the slide and let me know. Okay, now what do you mean by issue of sweat equity shares? Now, like the name says, sweat equity shares, these are equity shares that are issued to directors or officers or employees of a company in order to motivate them and retain them in the company. Instead of giving them a bonus in form of cash, they are issued shares known as sweat equity shares. So sweat equity shares is issued to keep the employees of a company motivated by making them partner in growth of the company. Such equity shares as are issued by the company to its directors or employees at a discount or for consideration other than cash, for providing their know-how or making available rights in the nature of intellectual property rights or value additions by whatever name called employee stock option plan. It is also known as employee stock option plan. So what happens here? Let's say the market value of the shares of a particular company going on are rupees 100. Okay, and you have certain employees in your company who are brilliant and you do not want to lose those employees. So you have two choices. Either you pay them cash and retain them in the company, or the next thing is you offer them sweat equity shares, also known as employee stock option plans. Now, what are the benefits of issuing equity or sweat equity shares or employee stock option plan? The benefits are mainly that if your market value of the shares is rupees 100, so if the person goes to the market or to the stock exchange to buy your shares, it is at rupees 100 today. So the company will issue those sweat equity shares or that equity share of the company to you for rupees 70. That is at a discount of rupees 30 than the prevailing market rate. So how does that benefit you? Obviously, if you are paying 70 rupees for something that is worth 100 rupees outside, you can immediately buy the shares of the company and go outside and sell it, and the differential is your money. So what the company here is doing, company is not giving you a cash, but giving you a way of making cash by giving you the shares of the company at a discount. So this, or it could be for a consideration other than cash. For consideration other than cash means that you do not still need to pay 70 rupees for that share. Instead of your services, they can just issue you the share. So they are not paying you, you are not paying them, but you've got the share of the company at a discount, using which you can make money outside. This is also known as employee stock option. So why does the company do this? The company normally does this to reward or motivate its employees, at the same time retain it without actual cash flow outside the company. So the company is not spending any money but giving you shares and giving you a means of making money outside by selling it in the open market. Employee stock option means the option given to directors, officers or employees of the company or of its holding subsidiary or subsidiary companies or companies, if any, which gives such directors, officers or employees the benefit or right to purchase or to subscribe for the shares of the company at a future date at a predetermined price. Now, what does this mean? See, please remember, when sweat equity shares or employee stock options are given to you, they are not all given to you today. Okay, so if the company has offered you 10,000 employee stock option plans, stock options, like the name says, all the options or all the shares you are not eligible to buy it today. What the company will do, in order to retain you so that you stay in the company for some time, it will break it up. Let's say, for example, for 4 years. So it will say, from today, after 1 year, you will be eligible to apply for 2,500 shares. After 1 year, from there, take another 1 year, you'll be eligible to apply for 2,500 shares. The third year, you will be eligible to apply for 2,500 shares. And at the end of fourth year, you will be eligible to apply for 4,000 shares. So what has the company done in this way? The company has actually made a way of retaining you for at least 4 months. Clear? So 4 years. So every year you can opt to buy 2,500 shares, 2,000, 2,500, 2,500, 2,500. That will become 10,000 shares. Okay. Now, of course, that will be at a predetermined price which is lower than the market price. And after 4 years, if you think that the market price of that share is lower than the predetermined price, obviously you will not buy it. Okay, you will buy it from the open market. Please take about 30 seconds, go through the slide. I will just get some water for myself. Okay, now let's have a quick look about the characteristics of preference shares, the issue and redemption of preference shares. The company to issue redeemable preference shares. No company limited by shares shall issue any preference shares which are irredeemable. Now, please remember earlier, maybe many years ago, the Act allowed you to issue irredeemable preference shares. Irredeemable means you do not need to redeem them forever or until the liquidation of the company. But if you notice, then that will make them at par with an equity share. So the Companies Act 1956 and the Companies Act 2013 amended it and made sure that no preference shares are issued which are irredeemable. They need to be redeemed, and the maximum period within which they need to be redeemed is 20 years. They cannot be extended or held for more than 20 years. It means within 20 years they need to repay or pay back to the preference shareholders the money, or either convert them into equity shareholders, either one, but they cannot continue to hold the preference shares for more than 20 years. Okay, shares to be redeemed out of profits only, and the company has to make a provision for the redemption of preference shares, and this reserve has to be maintained out of the profits of the company, and only from that reserve can the preference share capital be redeemed. Redeemed shares to be fully paid. Whatever preference shares the company decides to redeem, they all must be fully paid. They should not be partly paid. That means if it is a 10 rupees share, the 10 rupees should be paid, and not just 3 rupees or 4 rupees that you need to pay on the share. It should be fully paid up shares. Proposed shares to be redeemed shall be transferred to the CRR, Capital Redemption Reserve. Capital Redemption Reserve is a reserve created when you know that you have to redeem a particular capital. So every year out of your profits, you put some amount into your CRR, Capital Redemption Reserve, and then at the end of 5 years, 10 years, or whenever you want to redeem the preference shares, you will use that amount and redeem the preference shares. The class of companies whose financial statement complies with accounting standards. In case of unredeemed preference shares, paying of unissued shares to the members. Now, in case of unredeemed preference shares, or the shareholder is not available, or after maybe 20 years you cannot find out who the shareholder is, or he does not come and claim it, in that case that amount has to be kept for some time, and then it has to be transferred to the Investor Education Fund. Okay, that is a fund that is created under the Companies Act for the purpose of educating other investors and companies about the company law and other procedures. And then the paying of the unissued shares to the members, whatever is the redemption amount to the preference shareholders, that has to be paid up to the members, the preference share holders. Please take about 30 seconds, go through the slide, and then we proceed. Okay, now let's look at another provision of the Companies Act which relate with relation to transfer and transmission of securities and the allied provisions. Now, can anyone tell me what is the difference between transfer and transmission of securities? Securities definitely means equity share capital, preference share capital, and debentures. But what do you mean by transfer and transmission? Now, please listen. It's a very important concept. Transfer means when the shares or the securities are transferred from A to B, and both A and B are living. Okay, and then what is the procedure for it? But transmission means when A is a registered shareholder of a company and he expires or he passes away, then his shares can be transferred in the names of his successors or legal heirs. That means his wife or children or whoever want to claim it. That is the procedure for transmission of shares. So transfer means when the shares moves between two living people, and the transmission is when the share is transferred due to the death of a shareholder. So let's read a little more about it. Requirement for registering the transfer of securities. Please remember, any transfer of securities has to be registered with the registrar. That is, you need to follow the particular procedure. That is, there is a form for transfer of securities. What you need to fill up, both the transferor and the transferee needs to fill up that form. A price has to be fixed on that, and then both of them have to give that form signed and acknowledged along with stamp duty to the company, and ask for the company to transfer the shares. So then if the company finds everything in order, it orders for the shares to be transferred. So from A to B, and then after, if everything is found okay, then behind that share certificate it is mentioned that this particular share is transferred to B on so and so date, and then B's name is also entered in the register of members. Then in case of instrument of transfer lost or not delivered, in case the instrument of transfer is lost or not delivered to the company, then it is not deemed to be complete. The person transferring the shares and the transferee have to make sure that the instrument of transfer is delivered to the company in time for the company to proceed. Okay, power of company to register. If the company finds everything in order, that all the documents, share certificates and the procedures, everything is done, then the company can go ahead and transfer the shares from A to B and enter B's name in the register of members. Now, in the case of transmission of securities, now transmission of securities, obviously one person, the shareholder, is now no more. So due to his death, the shares are being transferred to his legal heir or successors, as the case may be. So then they need to submit a death certificate to the company to prove that he is no more, and also they need to prove their relation with him, and ask for the company to transfer the share or transmit the share of the deceased shareholder in their name. And then if the company finds everything in order, the company will make the changes and in the share certificate and acknowledge the share certificate and put a new person's name in the register of member, and remove the deceased shareholder's name from the register of members. Now all these information about the transfer as to whenever it happens, all this has to be intimated to the registrar of companies on a time basis, and normally this has to be done when the company files its AOC 4 and MGT 7, that is the annual returns of the company. Whenever that is filed, then you need to talk about the transfer and transmission of the shares. That is, you need to give details of the transferor, the transferee, the number of shares, date, everything, and then the registrar records these details in the respective place. Okay, then the transfer of security of the deceased, default and compliance. And if any default in these compliances and regulations is made, then every officer in default of the company will be liable for the default. Please take about 30 seconds, go through this, and then we proceed. Yeah. Now there might be cases when the transfer documents are forged, or they are received by fraud. In that case, it is called personation. If any person deceitfully personates as the owner of a security or interest in the company, or any share warrant or coupon issued in purpose of this act, and thereby obtains or attempts to obtain any such security or interest or any such share warrant or coupon, or receives or attempts to receive any money due to such owner, then in case that case, so a person, if by fraud or by deceit does any act by which he wants the shares to be transferred as his name, or get it to his name without the knowledge of the rightful owner, in that case he will be considered as a person who is a personation of a shareholder and will be punished accordingly as per the act, and can also be jailed for his punishment. The refusal of registration and appeal against refusal. If a private limited company limited by shares refuses to register the transfer of or transmission of the right of any securities or interest of a member in the company, the transferee may appeal to the tribunal against the refusal. If a public company without sufficient causes refuses to register the transfer of shares, the tribunal may come into the picture, may take appropriate action, and if a person contravenes the order of the tribunal. So if any person does not listen to the order of the tribunal, he will be punishable with imprisonment and fine, or both, as the law may talk about. Okay, so then let's talk about the rectification of register of members. Now, what is a register of member? A register is a statutory register to be maintained by the company, where the details, the name, address, number of shares, ledger folio of all the shareholders has to be mentioned. They are the members of the share. So the remedy of the aggrieved party for not carrying on the changes in the register of members. Let's say a share has been transferred from A to B, or a share has been transmitted from A to B. In that case, when all the documents are given to the company for the registration of that transfer or transmission, and the company does not do it or does not enter the new name in the register of members, then the aggrieved party can approach the tribunal, and the tribunal will investigate the case, will ask the company to get some more information, and based on the information will pass the order. That order also has to be filed with the registrar of companies within 30 days. The provision of this section shall not restrict the right of the holder of securities, where the transfer of securities is in contravention of any of the provisions of the Securities Contract Regulation Act 1956 and the Securities and Exchange Board of India 1992, then the officers in default of the company or the person making such transfer or transmission will be punishable or liable for punishment as per the provisions of the respective act. And then if there is any default in complying with the order of the tribunal or of any authority under the Contract Regulation Act 1956 or the SEBI Act 1992, then any officer of the company or who's in default will be punishable with fine or imprisonment, or both. Okay, so I will be ending the session on share capital and debentures today. But before I stop, I would like to again bring your attention to firstly the Unacademy app. Firstly, the benefits of being on the Plus platform of Unacademy. The Plus platform of Unacademy provides you daily live classes where you get to chat with your educator, engage in discussions and ask your doubt and answer polls, and all this while the class is going on. You do not need to make a separate time for it. You can do it on real-time basis. The courses provided by the Plus platform of Unacademy are structured courses. They are structured in such a way that they are in line with the exam syllabus to help you prepare best for it, and ensure that to the maximum extent possible no important topic is left uncovered. Then the Plus program of Unacademy also provides live tests and quizzes which help you evaluate your preparation with regular mock tests and quizzes and get detailed analysis of your performance in order to identify your weak areas and your strong areas, so that you can schedule your time accordingly. And lastly and most importantly, it gives you unlimited access. That is, one subscription to the Unacademy Plus platform gives you access to all the live and recorded courses to watch from the comfort of your devices and your homes at any given time. You can watch them at any given time. You can choose the topic, you can choose your educator and take the topic whenever you want. Then for those of you who have already downloaded and are using the Unacademy Learning app, I thank you very much for your support and request your support in future as well. And for the ones who have not yet downloaded the Unacademy app, I request you to download the Unacademy app and make use of it as soon as possible. You need to enter your mobile number, you get an OTP code, you need to register on the Unacademy Learning app using that OTP code. And what does that do? It opens your gateway to the world of courses, resources and contents that Unacademy has to provide to you, and all at your fingertips, at your convenience, at your location, whenever you want it, so you can carry it in your pockets. So I request you to download and use the Unacademy Learning app as soon as possible. And here are the details about the CA Foundation and Intermediate subscription packages provided by the Plus program of Unacademy. For the CA Foundation and Intermediate subscription, the Unacademy provides you packages for 1 month, 3 months, 6 months, 12 months and 24 months. The cost of the 1 month package is 3,500, 3 months is 8,750. 6 months is 14,000, 12 months is 17,500 and 24 months is 21,000. So you can make a choice of the subscription of what you want. But I personally would recommend you the 12 months and 24 months for two reasons. Being it is cost effective, and also for any major examination, especially for CA Foundation Intermediate, you require a preparation time of about 12 months to 6 months, 12 months to 24 months. So this will fulfill both those criterias. So, and whenever you have decided the package you want, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the subscription price. So the after discount price will be 1 month will be 3150, 3 months will be 7875, 6 months will be 12,600, 12 months will be 15,750, and 24 months will be 18,900. Do not forget to use the code Prathik, Prathik, to get a discount of 10%. I thank you all for being a patient audience today, and I hope to see you all on the Plus platform of Unacademy very soon. So let's crack the CA exams. Thank you and see you all soon.